Hello, and welcome to your Daily 5. My name is Greg Harmon. I'm the founder and president of Dragonfly Capital Management. At Dragonfly Capital, we manage separate account portfolios for clients using technical analysis and option strategies to protect capital and grow it over time. And we also sell a newsletter for those that want to try and manage their own account on their own. Find out more at dragonflycap.com. Today, I want to pose the question, has the Fed already gone far enough? And beating me to the punch this morning, the Wall Street Journal put out an article talking about the Federal Reserve possibly after their November meeting, when they move into the December meeting, not continuing the 75 basis point rate hikes that they've been showing us, and possibly going to 50 basis points. So that's another point of interest in terms of this story, and maybe the Fed is starting to recognize that they've gone far enough as well. But let me set the context around this first. Many market participants are looking at the bond market to try and determine its interpretation of what's happening with the Fed. But I think that perhaps the bond market may not be telling the story that people think it's telling. And I'm going to use this chart, this monthly chart of U.S. Treasury bond prices going back to 1990 to show the bull market in bonds. And we see right here at the end of 2018, a little kind of false breakdown out of this rising channel that had been going on for 26 years, 27 years. But then it quickly rose right back into that channel. Came back down here at the beginning of 2021, and just early this year broke the channel. Not only broke the channel, but I think the last time we spoke, it was holding around the 200 month moving average. Now we see that it's definitively well below that now. I believe that this is really indicative of a major secular trend change in bond prices and in bond rates. And if I'm correct about this, you're not going to get the signal out of the bond market that you expect to hear when you have anticipated its reaction to the Federal Reserve policy that has been going on since the 90s. So what would we look for instead? A couple of other big indicators, I think. Commodity prices. The first one I have here to show you is gold. This is a weekly chart of gold. And you can see here that we had an event that happened a few weeks back where the 200-week moving average and this long-term support since 2020 were in conjunction with each other. And since that time, we've had a lot of jostling around at this support level, and now a major breakdown through it to new lows, new 2-year lows, 2.5-year lows, with momentum continuing to drive lower. The MACD is showing that we're at the lowest level in many years. And what makes it such that it's anticipating, in my mind, that gold can still move much lower is this RSI is not oversold. It's just kind of bouncing along in the bearish territory. So if you look at it from that context, we've got almost like the Batman formation here, the double top that has been broken out. And we could anticipate a move down to even like the 1250 to 1300 area in gold. That's a major change for gold. You think gold maybe is not a commodity? Then let's look at copper instead. And copper, from the 2020 low in March, had a similar type of pattern, right? Moving up to a high here in 2021, where it got to overbought. And now has made a higher high here in 2022. But you'll notice that momentum is at a lower high. So we've got a momentum divergence in copper that has led to downturn here that retraced 61.8% of the move higher from the pandemic low to the top. A minimal bounce here and now moving back down again and stuck below the 200-week moving average. This chart continues to show weakness as well. It's trying to recover a bit here on the MACD, but the same thing with RSI. It went from oversold here to now just chugging along in bearish territory, set up possibly for another leg down. If we looked at on a measured move down from the 450 down to 320, another $1.30 down from 370 would take us down to 260, or no, I'm sorry, 250, down to this area, the 250, 240 area. Oil is another heavily traded commodity that is being impacted, I think, by rate hikes, as well as we know other characteristics of global chaos around the world. But we've seen a downtrend in gold since June. We have that same divergence here in momentum, negative divergence in momentum versus the top in the price action. A bounce down to, or drop down to the 100-week moving average with a bounce back up and a quick reversal back lower. And oil looking like it's possibly the strongest of the commodities so far, but off substantially from the beginning of the year and even the June area where we had the quick rise from the conflict, the war in Ukraine. And then finally, I'm going to take a look at natural gas. And natural gas also had a big run up from the 2020 low. And from the 2020 low up to the high in June of this year, pull back to the 50-week moving average, and then a second top, a higher high, but again, on a negative momentum divergence. And now we're back down, testing that low today, and pulling through that low as markets are trading today. Momentum still driving lower here, as well as on the MACD, and showing that there's room for much more downside here as well, maybe down to the 360 area. So what's the point of looking at all of these charts and saying that they might show us more about what the Fed is doing and the impact it's having than bonds? Commodity prices have been off substantially. The Fed's goal, their stated mission, was to rein in inflation. And we're starting to see it first in the commodity prices. It hasn't happened in the labor market. It hasn't happened in the housing and rental market yet. But with mortgage rates now hitting 7.37% yesterday, we know it's going to have an impact there as well. So it looks to me as if it is time for the Fed to slow down, at least take a pause and review what the impact is of inflation that is going to be showing up as a lag following the policy of the FOMC meetings and their interest rate hikes. I don't think that there's any real damage to be done with a 75 basis point hike in November, as the Fed funds futures contracts have already priced in that happening with 99.5% certainty. So it's essentially done already. It's the December meeting that we need to start focusing on now. And the more we hear from sources like the Wall Street Journal or directly from the Fed when they have their window open again, that we'll start to see perhaps some more clarity around that. That's my Daily 5. Thanks for watching.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.